Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining me at the market site in Times Square, we have Joyce. He's a managing director on Nasdaq's Market Intelligence Desk with a midday update. Brian, great to have you with me as always. And it seems as if it doesn't even matter what's happening midday. It was around 9:38, 9:39 a.m. Trump put out a tweet. The trade deal's going very good, and it's been, stocks are red, now they're green for the rest of the day.
Right. The number of headlines and tweets we've seen regarding the trade deal, it's dizzying. Yesterday, it looked like maybe something was not going to happen. This morning, now it's happening. Even today, it's been flip-flopping back and forth intraday, and now it seems to be more on the optimistic side. So,
yeah, I mean, you would think with all this uncertainty with the trade deals, the major averages hit intraday all-time highs this afternoon.
Correct. So, maybe there's other things going on besides, these trade deals.
Yeah. All right. Well, there's a new sheriff in town over at the ECB with Christine Lagarde. So we're going to take a look at our first chart today. It's daily on the Europe Stocks Bank Index. And you've been talking about the banks for quite some time now, but with Europe not making any changes with their interest rate policy either, it sets up for something interesting.
Yeah, so we highlighted this bank index on the long-term chart back in mid-August and again in September. The Europe Stock Bank Index, there's 26 members within the index from the largest banks throughout Europe. And it's been testing secular lows. It's been hitting 30, 40-year lows. And so clearly defined support levels. And so there's a lot of certainly bearish news out there regarding banks and negative interest rates. And at the prior policy meeting with Draghi, they cut rates further into negative territory. So bad stuff's going on. But this is now actually the fourth straight month that the index has been, making, a move to the upside. And today it's up 3% again.
All right, let's see if we can get that daily chart up there. All right, there we go. Looking at some of the support levels you were mentioning earlier.
Right, so here's what's going on. So we made the low here in August. We're up right now 25% from those August lows, and nothing really new has happened on the fundamental front for the banks. What's going on today, we had Christine Lagarde, the new president of the ECB, her first policy meeting, and what she basically is saying is a couple things. One, they're going to have a policy review to look at new things in the ECB toolkit, which, by the way, is what the Fed is doing as well. So if there is a need for further easing down the road, maybe we could do something other than continuing to cut rates further, which has really been hurting the banks, as you can see. If we had a long-term chart up here, you would notice that that August low is a 30, 40-year low. So a major bottom here. We have it on the daily chart. You'd also see the inverse head and shoulder bottoming pattern. We're getting a breakout now above the recent 4-week declining trend line. We can see the 200-day moving average has been resistance initially in October, and then in late October and just a week or two ago is now acting as support, which is common technical price action. So today's 3% breakout from that price channel is now resuming this 4-month uptrend. We have another about 8%, 8 to 9% to go based on the size of the consolidation range, which takes us up to about the year-to-date highs we made back in April. It's already had a 25% move to the upside, but if you think about it this way, it's still 50%, about 48 to 50% below last year's highs alone. If you want to take it back to 10 years, the 2009 highs were about 150% below those highs, and just 2 years before that, 2007, this index is about 400+% below those highs. So I give those numbers just for context. Those certainly are not targets that we think where it's going, but certainly it looks like maybe something has changed here, and what that could be is new president of the ECB may now have a change of direction as far as providing stimulus down the road. It's going to certainly take some time. We won't see it in the next quarter or 2 quarters on the bank's balance sheets, but price often leads fundamentals. And I think maybe what investors are looking at, they're looking longer term here, and maybe what we'll see is new measures for easing to stimulate the economy. Maybe the banks will put pressure on local governments to step up and maybe increase fiscal plans, things like that, fiscal ideas, fiscal measures, increase spending, so we don't have to continue to go down into negative rates.
All right, and if we move on to our next chart here, this is the same index, but on the weekly. Is it confirming what you think on the daily?
Yeah, well, this actually is the monthly chart. So this goes back all the way to 2009. As you can see, those August lows were essentially 10-year lows. And this chart, you could extend this back 30, 40 years, and it would tell you the same story. This has been the low, and so we're bouncing off major secular lows right here. And right now, if you look at the monthly MACD on the bottom, just last month it crossed back up above its signal line. That's its 9-month moving average. Typically, when momentum has a bullish crossover like that on this time frame, it could really go on for a period of time.
I have weekly up there. Should have opened the chart and taken a look at the axis
no
on the bottom for the time frame, but we can see what it is here. Let's go along to our next chart because clearly there's going to be some movement in the Bund as well.
Right, and so banks are very sensitive to interest rates, and we know the short end of the curve right now is pretty much locked down. We're not expecting a cut or a hike by the ECB anytime in the near future. I think that is the widespread consensus around on the street. And so this here is the 10-year yield, the long end of the curve. And what we see is it's been, rising and steepening the curve, since early September when it bottomed around negative 74 bips. It's already now about minus 25 bips or so. Today we're back above the 200-day moving average, which we've seen a couple of times over the last month or two, but we've never seen 2 consecutive closes above it. If we can do that, that's a small achievement, I would say. I'd like to see it get back above the July highs around minus 22, minus 21 basis points. If we can get that breakout, and I think we possibly can, then this potentially has a move up to, not just positive territory, but maybe 25 basis points. That would certainly really steepen the curve, would certainly be very bullish for banks.
Which is so interesting because you don't typically think of charting a yield curve or, charting where yields are right now. Typically in financial media, you hear about what's happening within the marketplace that's moving the yields, not necessarily looking at it from the perspective of charting. So kind of like a technical analysis 101, you can essentially look at any price action and still apply the same principles.
Absolutely, and that's the good thing about technical analysis. For the most part, I mean, commodities can be a little bit different, or you can use different techniques, but for the most part, price action is measured on the same, support resistance lines are measured the same, and in fact, rates have been acting very technical. We wrote a note a couple of months ago in September, I believe, where we said we thought the 2-year yield was bottoming. I think it was actually the first week in October, after, say, a 12 to 18-month downtrend, and that actually turned out to be the day it bottomed. And it wasn't because we had some magical cap on, but we were just identifying clearly defined price levels where we expected, or where in the past we saw price react on a number of occasions, and price support turns into resistance and vice versa. And whether you're looking at moving averages to support that, and they have your cluster of support, things like that come into play, and they don't always work, but a lot of times they do. And the point of it all is to identify risk levels where you could put in an investment and act from there.
All right, great stuff as always, Brian. Thank you so much.
Thank you.
And thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.